Hey, my name is Aaron Montel. I'm with Local Advantage Mortgage in Denver, Colorado. We're local. Yeah. Thanks for taking a few minutes to watch this video. This video is a companion piece to a blog I recently published. And I published the blog because of a recent experience I had with some clients and talking to some other mortgage loan officers. And I'll get to that experience at the end of this video. But I want to set it up in this way. Of course, every good loan officer is going to know the products and programs available. They're going to be able to look at your situation, your income, your credit history, and what you're trying to accomplish, and they're going to tell you which one's best for you. Conventional loan. Maybe you're a veteran, you can benefit from the VA programs. FHA. Are you an investor? Are you looking to buy an investment property or a second home? They'll be able to tell you which product is best for you. They'll tell you the documentation you need, tax returns, W-2s, pay stubs. Are you self-employed? Do we need to look at your profit and loss statement if you're self-employed? Every good loan officer is going to be able to check these boxes, know these things. At least they should know these things. But what I want to talk about today is beyond that. I want to talk about how do you, the consumer, know that the loan officer that you're talking to can not only do all these things that presumably all loan officers should be able to do, but how do you know if the one you're talking to is going to bring added value to you, the consumer, and what that means to you? That's what I want to talk about today. And to get at that, I've come up with three questions. And I think that for a financial professional who is in a position to advise consumers, I think these three questions should be pretty darn simple. All right. Um, and maybe everybody doesn't have the same answer, and that's fine. But your financial professional, your mortgage advisor, should have an answer. So I would, I mean, and hopefully the answers are probably pretty close because, I mean, while they could deviate a little bit, the crux of it is still the same. And I would advise that if you want to use these questions, and I strongly urge you to ask them in a setting where, of course, that loan officer doesn't have the opportunity to research and get back to you via email or something like that. Just see what they really know, just off the top of their head. Question number one: what is the current yield on a 10-year treasury? Current yield on a U.S. 10-year treasury note. Ask your loan officer that. Question number two: what is the yield curve and why does it matter to me, the home buyer? What is the yield curve and why does it matter to me, the home buyer? And my third question to ask your mortgage loan officer is: what's your opinion or forecast for mortgage rates in the near term and the medium term? Can you identify, and this is question 3A, can you identify important price levels of the underlying mortgage-backed securities? Of course, we all learned in 2008 that mortgage-backed securities are the instrument that trade on Wall Street that dictate the rate which we pay for a mortgage. So question 3A again, can you identify important price levels of the underlying mortgage-backed securities that would lead you, the mortgage loan originator, officer, to form an opinion of whether or not I, the consumer, should lock an interest rate now or float an interest rate to some point in the future in hopes of a lower rate of improving market conditions? Those are my three questions. The answers to those three questions are found in the accompanying blog to this video. If you're watching this on YouTube, I'll leave a link to the blog in the comments below, so you can find it there. Also, I do want to share one more thing because I hear this all the time, and as a professional in this industry, as a professional in the mortgage industry who really wants to help consumers, every time I hear this from a colleague, it drives me insane. It drives me absolutely crazy. If you, the consumer, are working with a mortgage loan officer and you ask them about locking your interest rate, you say, Mr. Loan Officer, should I lock my interest rate today? You've told me what today's rate is. Should I lock that rate? If they answer your question with a question, big red flag. If they answer your question with this question, do you like the rate, Mr. Consumer? If they say, do you like the rate, when you ask them if you should lock the rate, that is a big red flag. It means that they have little or no understanding of the market's that dictate interest rates. It means that they don't have an opinion. It means that they're not advising you and they're putting the decision back on you without any real insight or opinion. And I got to ask you, is that the person you want to work with? Because that's the type of added value that you need. That's the type of added value that's going to lead you to get just a slightly better deal, a slightly better interest rate. I know nobody's right 100% of the time. I've been a technical analyst and a trader for 15 years, and I'm not right all the time. I'm certainly not, but I do have an opinion all the time. Let me show you an example of that. This happened just a few weeks ago. It was, if you recall, so I'm recording this video on February 11th, 2023. And the example I'm going to show you happened back on February 2nd. February 3rd was the January jobs report, which, if you recall, or maybe you don't, but the January jobs report told us that there was much more job creation in the month of January than even the most bullish estimates. And so that happened on February 3rd. Now, on February 2nd, which was a Thursday, I'm going to show you here on this chart right here. You see this little red candle with the long lower shadow? Well, that was February 2nd. That was the day before the jobs report. Look at this level right here. You can see that this level seems to be pretty important, as the 10-year Treasury floated down to 3.4 back in March and April. That's where it bounced. And then it floated back down to 3.4 in September and October. That's where it bounced. Of course, a lower 10-year Treasury is also lower 30-year mortgage rates because, as I explain in the blog post, the 10-year Treasury and 30-year mortgage rates, they move in lockstep. They are highly correlated. Of course, there's been times in history where it got a little wonky and that wasn't the case, but more times than not, they are very much correlated and they do move in lockstep. So if we're seeing lower yields on the 10-year Treasury, we're also seeing lower mortgage rates. And I assume that that's what you as a consumer and a home buyer want. You want to pay less interest on the money you borrow to buy your home, right? So the lower 10-year Treasury, it basically equates to a lower mortgage rate. So here on March 2nd, I did notice that the price, the yield on the 10-year Treasury was back down at these support levels. Also noticed that it touched this blue line, which right here is the 200-day moving average. And I noticed this long, let me get rid of this line so you can see. But if you see this long red line here, it's a long lower shadow or a long wick. That means price came down and reversed higher before that day's close. And all those things combined told me, plus the fact that there was a jobs report that I was aware of coming out the next day, that told me that there's some pretty good support here. The odds of rates continuing lower versus rates reversing higher had shifted. The risk reward proposition had shifted for my clients who were floating their interest rate. So I called them. And there's some other indicators here, but that's basically it. So I called my clients that day, late in the day after the market close, and I explained to them, listen, Mr. Client, the risk reward proposition here had shifted. And I basically told them exactly what I just showed to you. And it's not my job to to make the decision to lock the rate. It's not my job to make that decision. It's my job to provide insight and guidance for my clients to make the decision that's best for them, because everybody has a different risk tolerance. Right. So, I might run into somebody who said, yeah, that's great, but maybe it'll go lower. I'll just see what happens. That's their decision. I'm just here to provide guidance and tell them, listen, this is what I think. And also I'm here to tell them, yeah, well, if it goes too high, it's going to affect your loan. Or, if there's potential material issues with not locking it, I'm here to advise on that as well, of course. But the bottom line is I'm here to advise, not make the decision. Anyway, Of course, you can see what happened in the following days, as in the next 6 or 7 sessions, the Treasury yield rose back up to 3.8, where now it's finding a little bit of resistance on the 100-day moving average, and that's fine. But what does this mean? This means that on Thursday afternoon, when I locked those clients' interest rates after having that conversation with them, they got the benefit of this, not this, which means the difference between 3.4 and 3.8 on the 10-year, convert that to mortgage rates, that's about 0.5%. So on Thursday, let's say it was a 5.5% rate. Well, today it's over a 6% rate. Fine. What does that mean for dollars? What does that mean for monthly savings, having a rate that's 0.5% cheaper? It depends on the size of the loan. I will say that because, when things are calculated in percentages, the size of the loan matters, obviously. But let's just say that the difference between 5.5 and 6%, let's call it $100. It's probably a little north of that for most people. On a $350,000 loan, it's probably around $120 a month. That's $1,200, $1,300 a year that a client saved simply because I was paying attention to the market and I understand what these levels mean. I do. I understand what this means. I understand that, hey, when this happens, risk reward is shifting and we need to have a conversation. I'm engaged in these markets. I've been doing this type of analysis for a long time. And this is the added value that I bring. And that added value saved some of my clients $100 a month because we knew to take advantage of this because the probabilities were this, not lower, in a nutshell. Anyway, I hope you will take the time to read the blog because the blog contains the answers to those 3 questions. What is the current yield on the 10-year Treasury? What is the yield curve? And why does it matter to me, the home buyer? And question number 3, of course, was what is your opinion or forecast of mortgage rates in the near term and medium term? The answers to those questions are included in the blog. I hope you take a few minutes to read it. I appreciate you spending a few minutes with me here today, and I hope you come away from this video with a little information, maybe a little something to carry forward, and I hope the blog provides some insights for you as well. I'm always here to speak. If you have questions, please feel free to reach out to me however you prefer. Give me a call, shoot me a text, or shoot me an email, and all that information is available on the website, which is linked below, or you're already there, depending on where you're viewing this video. Thanks again for your time. Talk to you soon.